Welcome back to the Dorian Finance Podcast, where we discuss finance, business, and much more. This episode's topics are how to find buy and hold investments, subtopics, what is index investing, how to measure investments, the FIRE movement, and then also we talk about how to pick the best credit cards, and then I dive into my analytics for YouTube and TikTok for this week. I'm your host, Dorian, and I'm thrilled to be your guide on your path to financial freedom. Let's get started together. Can you do me a favor and follow my podcast and review my podcast, because this really helps me get this out to more people and helps me to improve my content. Thank you. Now for the first topic, how to find buy and hold investments. Buy and hold investments refer to a strategy where an investor purchases assets such as stocks, bonds, or real estate with the intention of holding them for an extended period, often many years or even decades. This strategy has its own sets of advantages and disadvantages. Now the advantages, I'll just go over them quickly: compound interest, less stress, and tax benefits. First of all, compound interest is as your asset appreciates, meaning it goes up in value, it compounds where a $100,000 house compounded $8,000, that's only 8%, and then, keeps on compounding, or stocks, it keeps on compounding, and even if it had a return of 8%, in 10 years, it's actually over 100% return if it is compounded interest. And what I mean by less stress is, for example, you buy a house. Okay, yes, you'll have to get tenants in, but you won't have to constantly think of, let's say you're a flipper versus just buying a house and holding it. A flipper, you have to find the property, you have to do all the stuff a buy and hold investor does. But then you have to do that multiple times a year. Say that you do that, let's say 12 times a year versus once a year. You have to go to closing about 24 times because you're buying it, you have to go to closing, and then you have to sell it, you're going to closing. And that is very stressful sometimes. And then, what if something long-term investing is, I'm buying this and I'm going to keep an eye on it, but I'm not going to worry about buying, selling, and hoping that every single time I'm correct. And then same thing with the tax advantages. Long-term capital gains tax is actually lower than short-term gains. Now, there's many more advantages and disadvantages. I'm just doing the top ones that I personally like. I will link a blog post that I created that has more advantages, more cons to buy and hold as well. Now for the disadvantages of buy and hold investments: lack of liquidity, opportunity costs, no short-term gains. Lack of liquidity is your assets are locked up, your cash, so just in case of an emergency or opportunity that requires capital right now, you won't be able to do it, which you have to keep in mind of having a emergency fund before investing. And then the opportunities, again, you want to have some cash or even have some assets that you can sell quickly to then follow up a awesome opportunity. Opportunity cost is a concept that's in business and finance, which is, anytime you buy something, it means you can't buy something else. It is a big what if game. At the end of the day, you can always look at whatever you bought as a learning lesson. Opportunity cost is you're tying up your money in a long-term investment that might not be available for you to buy a different asset that can arise with short-term gains. The last one, which is no short-term gains, is a common thing, which is, the dips in the market, you buy an asset and then you sell it when it goes up really fast. That happens, but that's if you're a very good investor, very educated and aware of circumstances that you can do. So those are all the top cons that I want to point out now to find buy and hold investments. First of all, you want to define your investment goals, whether it's retirement, education fund, or just acquiring wealth. And then you also have to figure out what's your risk tolerance, how much you can tolerate the market being volatile or not. After that, you want to educate yourself and learn different asset classes such as stocks, bonds, real estate, commodities, cryptocurrencies, all that type of stuff. You want to learn what they are. Research investment opportunities, read financial news reports and publications to identify promising companies, industries, or sectors. Use investment research platforms such as Yahoo Finance and many other platforms to get educated. Some hot topics on this, as well as you want to seek investments in companies with a competitive edge, such as a strong brand, think Nike, or intellectual property, think Disney, or market leadership, think Google. And then you also want to review historic performance, see if the asset has grown over time. Because you're doing long-term investing, you want to make sure your asset is growing over time and it shows a record of growing over time. Fundamental analysis, which is you're looking at the financial statements such as income statement, balance sheet, cash flow. That's for stocks and bonds. And then you can do technical analysis, which is looking at the chart and seeing if it goes down or up at a certain period. Say if it's a seasonal company that only goes up at certain times, you can see that and then you don't have to panic as well. And the last step that I want to point out is stay informed, keep up to date on your investments, the economy, the market developments of investments around the world. Be prepared to hold your assets through recessions, through a pandemic, through political upheaval, and many other things that changes the landscape of things. Before I get into the next topics, I just want to leave this time for questions, comments, and what do you think of how to find buy and hold investments, the pros and cons as well. Please comment below what you thought about that part. Now, to keep up with the theme of buy and hold investing, index fund investing is a passive investment strategy that involves buying a portfolio of assets such as stocks and bonds that closely mirror the performance of the overall market with the goal of achieving returns of the overall market. Here's how index fund investing works. Select of the index, an investor chooses to participate in a market index such as the S&P 500 or the Dow Jones Industrial Average has a basket of stocks. This basket can be S&P 500, Dow Jones 30 of, the top 500 American companies or the top 30 companies. And the beauty of index fund investing is it's also passively managed. So the index fund manager follows a passive approach. They do not attempt to pick stocks or time the market, but instead focus on maintaining a portfolio that closely tracks the performance of the market, which lowers the cost of the index fund compared to actively managed funds. And then because, for example, the 500 or the 30, it's automatically diversified as well, and it will also track market returns most of the time. If you go to a business conference, an investment conference, you'll hear the word ROI. What's the ROI? What's the ROI? Thrown around all the time. ROI stands for return on investment. You also hear ROE, which is return on energy, but that's another topic. So how to measure return on investment, which is a simple formula, which is the net profit divided by the net cost times 100. So for example, let's say that the net profit was $20,000 divided by the net cost, which was $100,000, times 100, which would be a 20% profit. And again, it's important to keep in mind that the return investment formula is just one way to measure profitability of an investment. And there's other factors like risk, time horizon, and cash flow. You can have a huge ROI, but if it takes too long, that ROI is actually less because of opportunity cost. Now moving on to the next topic, which is FIRE movement. And FIRE movement stands for Financial Independence Retire Early. The FIRE movement is a lifestyle and a financial philosophy that has gained popularity in recent years. The movement emphasizes the idea of smart saving and investing to achieve financial independence at earlier age, allowing individuals to retire or pursue their passions without relying on traditional employment. Key principles of the FIRE movement: financial independence, retire early, high savings, investing, minimalization and simple living, and geographic arbitrage. Now, going back to financial independence, people that follow the FIRE movement aim to acquire enough savings and investments to cover their living expenses without needing to work for a paycheck. Retiring early instead of traditional retirement, this age they're aiming for 30s, 40s, or 50s. High saving rate, which means that the people that are following the FIRE movement are typically saving 50% of their paycheck to enjoy life quicker. Investing to make their savings grow and outpace inflation. FIRE emphasize investing their income in various assets such as stocks, bonds, real estate, or other income generating investments. Minimalization and simple living is really adopted by, okay, you're investing 50% of your paycheck, you're cutting back to only the stuff that brings you joy and purpose, cutting back on any unnecessary purchases. Now, geographic arbitrage. Some FIRE followers take the advantage of geographically moving to a area that has lower costs of living, especially during the phases of the journey to lower expenses. Now, getting more in depth of the FIRE movement, how it works. And first of all, you want to set your financial goals. First step is defining your financial goals, determining the age at which you want to achieve financial independence and the lifestyle you desire during retirement. Again, you're having the high save rate of 50% minimum so that you have to determine things. And next step is budgeting and expense tracking. Creating and maintaining a detailed budget is crucial to help identify areas of wasteful spending and to help to allocate more funds to your savings and investing. Then the investing for growth is the ideal strategy, which is bonds, stocks, real estate, or other investment strategies. And again, you still need to have an emergency fund, which you can then also use other strategies with that money that's laying around and keep it liquid. And then you also want to maximize your income and try to increase your income through salary raises, side hustles, entrepreneurship ventures to help improve your income. And then you also want to keep in mind of tax optimization, which is using your retirement accounts as well as your 401k if your employer gives you a good incentive to use them. Because if you're going to retire in your 30s or 40s, these accounts, you can't even touch the money until you're in your 60s or 65. So it's kind of annoying. And then you always want to keep monitoring and adjusting your strategy so you can keep pace with your plan of retiring early. And then last is because you're going to be in your 30s, 40s, or 50s, you have to have a withdrawal strategy so you don't just blow all your money and also spend it on a lot of high taxes. You want to be able to have that money for the rest of your life and potentially also give it to your family, kids, your friends, or charitable foundations that you want to support. And you have to also keep in mind, okay, you have to get enough money to live on, but also it has to be enough that you can live on for the rest of your life in your 30s, 40s, or 50s onwards. Now, to help you determine how much money you need to retire, there's two different principles, which is the rule of 25 and then the 4% rule. The rule of 25 is you need 25 times your annual expenses to retire. And to get that, say that for a month, your monthly expenses is $6,000. You just multiply that by 12 to get $72,000. And then you take that $72,000, multiply it by 25, and you get $1.8 million. That's how you use it to determine how much money you need to retire, because then you're using the 4% rule, which is you're only withdrawing 4% of that $1.8 million, and you're living on that 4% because ideally that money will grow at a 4% rate so that you can basically live on that money for the rest of your life. Now, I just want to have a little bit of fun and highlight different types of FIRE movement strategies. Like the Lean FIRE aims to achieve financial independence and retire early by living a extremely frugal lifestyle and cutting back all expenses to the bare minimum and to cover only the basic needs and necessities. And then the opposite of that is FAT FIRE, which is to have a good lifestyle throughout the whole thing and to then retire in luxury as well. Barista FIRE is that you plan on retiring, but you're going to have a part-time or less stressful job, such as being a coffee shop employee or something like that, to cover some of your basic living expenses. Or Coastal FIRE is an individual who has already saved up enough money to retire at the age of 65, but continues to work without adding any more money to the retirement account because they already have it. And then there's many other ones, but it's fun idea of thinking, okay, do you want to live a frugal lifestyle in retirement, or do you want to go travel the world? Do you want to live in luxury? Or do you want to have the idea of you want to have a part-time job in retirement, have something to do, which for me personally, I have had the opportunity and the privilege to meet and talk to a lot of people in their retirement. Most of them are between barista and Fat Fire because they want to have something to do, so they'll have a part-time job that they like, and that's what they do. What do you think about the FIRE movement? What's your questions about the FIRE movement? What's your comments about the FIRE movement? I'm open to hear every feedback. Moving on to how to pick the best credit card for you. And in my blog post, I go more in depth. I give more examples, more information on it, but I want to keep this very simple because of the podcast. First, you want to look at your spending habits, where you spend the most money at a store. Reason for it is a lot of stores have their own private credit card that can give a good bonus and also good money back for using it. But you have to compare that with the big bank cards and also determine how much you shop there. If you only shop at a certain place like once every other month, it's not worth having their private card, because a lot of store cards, you can only use it at that store, or they're usually a MasterCard that a lot of places don't accept. So you want to look at your spending habits, then determine your primary goals with the card. Before you apply for it, you want to make sure that their fees are a little bit low. Determine whether or not you're going to carry a balance or not. if you're going to carry a balance, you want to have a APR very low on the interest rate. And you also want to make sure that you're not paying setup fee, what they usually call an annual fee, just to have the card. That is ridiculous unless they give you enough bonuses to make it worth your while. So you want to compare the fees of the card that you want, and then you want to review their reward program. If you have a credit card that doesn't give you any cash back, doesn't give you a bonus, it's not worth having unless you're building up your credit. But that's another hypothetical, another example of what you do. Again, for you, if you have no credit cards, you're going to be doing a secured card, and I have videos and also blog posts about that. But before you apply for a new credit card, check what your credit score is and what credit score do you need to have to get that card, because you don't want to do a hard credit check just to get denied on a credit card, because the hard credit check does impact your credit for a short time. What do you think of how to pick the best credit card? What's your comments? What's your questions? Feel free to comment below. Now to dive into my analytics on YouTube, and I'm using YouTube's own analytics tool. I know that there's like vidIQ and a few others that you can dive more into, but I decided I'm doing this. Total views was 172 for this week, total 1 hour watch time, and I gained 1 new subscriber. Welcome. Woo! And then my top 3 videos were how to make a budget, the long version, which I was shocked, with 105 views on it just by itself. The second video was step-by-step how to create a long and short videos on TikTok and YouTube with 39 views. And then was what is financial independence, retire early, ? Fire movement, which I might actually change the title of that. And that was my YouTube analytics. I was happy to see that I got a 1 hour of watch time and a whole new subscriber. That was fun for this week. If you're a YouTuber that has done it a while, a professional YouTuber, please go to my channel and critique it and give me some advice on how to improve it, and either comment below or DM me directly. I would love to hear your opinion on that too. Now moving on to my TikTok analytics, which their analytics is quite different, so I can't really compare apples to apples with YouTube as much. And the total views was 753 views, which I was happy to see. Profile views was 22, so 22 people were considering following my channel. Total likes was 5, 2 comments, and then 10 new followers. Woo woo! I'm very happy about that. And then I was also, it highlighted how many videos I posted this week, which was 4 new videos. If you're a TikToker that is a professional TikToker, please comment below what you think of my TikTok channel and give me some tips on how to improve it, how to grow faster. And I appreciate any comments, any advice. And also, if you don't want to comment below, you can always DM me as well. Thank you. Thank you for listening to the Dorian Finance Podcast, where we discuss finance, business, and much more. I'm Dorian, and I'm your guide on your path to financial freedom. And if you've listened to this point, follow my podcast and leave a review on my podcast, because it helps me. Thank you, thank you, thank you, thank you, thank you.